Okay, let's unpack this. Imagine this scenario, right? You're scrolling on your phone, you find a pair of shoes you like, or, I don't know, maybe you're just picking up a €5 coffee at a train station on your way to work.
Yeah, just a totally standard everyday purchase.
Exactly. And you get to the digital checkout, you tap a little button that says, buy now, pay later, and in a fraction of a second, the coffee is yours. The shoes are in the mail. It feels completely frictionless, right?
Oh, absolutely. It's designed to feel like just a tiny everyday convenience.
But behind that single click, there's actually a massive invisible machinery of European financial law that's kicking into gear. So welcome to the deep dive. Today, we are taking a really fascinating look at the hidden legal architecture that governs exactly how we borrow money in the modern world.
It is truly a profound shift. I mean, we're looking at a complete overhaul of how consumer credit is regulated, assessed, and policed across the board.
Right. So our mission today is to decode the European Union's new Consumer Credit Directive 2. And specifically, we're looking at how it's rolling out in the financial hub of Luxembourg under Bill 8708.
Which is a huge deal, and we've gathered a solid stack of official texts for you. We've got the directive itself, straight from EUROLEX, the updates from the CSSF,
which is Luxembourg's financial regulator, right?
Exactly. Plus all the relevant parliamentary documents. So we are going to translate all that dense regulatory text into the practical operational realities that are going to permanently alter how digital purchases work by November 2026.
And to really grasp the magnitude of this, we first need to establish what actually counts as credit today, because the definition has expanded radically to match our modern habits.
It really has. I mean, historically, when you thought of credit, you thought of going into a bank branch, sitting across a desk from a loan officer, and signing paperwork for a car or home renovation.
Right. It was a major life event. You didn't do it for a cup of coffee.
Precisely. But the new directive captures a much, much wider perimeter. It certainly still covers those traditional loans, deferred payments, credit cards.
They're the usual suspects.
Yeah. But the massive structural change is that it now explicitly targets point-of-sale financing and buy now, pay later products.
Oh, those digital arrangements where you split the cost of an online purchase over a few weeks or months.
Exactly. And this all comes down to the financial thresholds, because the old rules under the Luxembourg Consumer Code basically ignored the small stuff.
Right. If you borrowed less than €200, those rules just didn't apply.
Exactly. And if you borrowed more than €75,000, it was treated as a different category altogether. But this new bill, Bill 8708, proposes blowing that range wide open.
So we are talking about capturing everything from just one single euro all the way up to €100,000.
That is the pivotal change. The €200 floor is completely gone.
Wow. Okay, so the best way I can think of to visualize this for you is to imagine a fishing net. The old regulations were like a net woven with really wide gaps.
Designed specifically to catch the big fish.
Right, your car loans, your kitchen renovations, all the little fish, like a €50 sweater or a €5 deferred coffee payment. They just swam right through the holes without anyone noticing.
Yeah, completely unregulated.
But now, regulators have taken that net and woven it incredibly tight.
Yeah.
It is now designed to catch the minnows. So that €5 coffee you put on a payment plan is suddenly being treated with serious regulatory weight.
And what's fascinating here is the why behind that tighter net. The primary policy objective is consumer protection. Because, in an increasingly digital environment, microdebt is incredibly easy to accumulate.
Oh, totally. A few clicks here and there and it adds up fast.
Exactly. If you buy a €20 item here, a €50 item there, and split them all into deferred payments, you can quickly find yourself in a really complex web of debt without ever having taken out a quote-unquote traditional loan.
Which makes total sense from a consumer protection standpoint. They had to bring the entire digital credit ecosystem into the light.
Right. To harmonize the internal market across Europe, they could no longer ignore the minnows.
But naturally, if that net is now catching every single €1 transaction, how on earth do banks and financial institutions handle that? Because every time they launch a new feature on their app, they suddenly have a mountain of regulated products to manage.
And this is exactly why the market views this directive not as a simple update to consumer-facing wording, but as a deep structural governance exercise.
So they can't just slap a new disclaimer on their website and call it a day.
Not at all. Financial institutions have to engage in what the industry calls building a defensible launch package.
A defensible launch package. That sounds Very intense. Explain that to me, like I have no legal background. What does that actually look like inside a bank?
It basically means a bank needs an ironclad paper trail, proving they checked all the legal boxes before a new digital product ever hits the App Store. Before they can offer you a way to split your payment on those shoes, they have to run a gauntlet of checks. They have to review the scope of the product, approve the advertising, check the pre-contractual information you see on the screen.
Wait, I have to jump in here.
Yeah.
Because as a consumer, isn't this just going to result in banks drowning us in more fine print?
That's a common fear. Yeah.
Like, we are already exhausted by endless terms and conditions checkboxes that literally no one reads. If they have to build this massive paper trail for a €5 purchase, aren't they just going to make the checkout process unbearably complicated?
It's a very valid concern, but the short answer is no, because the law anticipates exactly that. It's not about forcing more text onto the consumer.
Oh, really?
Yeah, it's about demanding aligned text behind the scenes. Every single piece of your customer journey must connect seamlessly, from the very first Instagram ad you see to the final annual percentage rate calculation.
So the commercial, compliance, and legal teams all have to be telling the exact same legal story.
Exactly. The defensible launch package isn't a massive booklet they hand to you. It's the internal audit trail that proves to the regulator that the bank isn't being deceptive, predatory, or careless.
Okay, so it's less about making me read 50 pages of legalese at checkout and more about making sure the bank's marketing team isn't making promises that their legal team can't back up.
Right. The compliance officers have to be able to look at the automated digital screens and confirm that the exact legally mandated consumer warnings are present.
Got it. But speaking of automated screens, if banks have to do this thorough review for every tiny transaction, they obviously can't have a human loan officer sitting there reviewing a €5 deferred payment.
No, that would be impossible.
Right. So they have to rely on data and automated algorithms to make those split-second decisions. And that brings us to what I think is the most dramatic part of this entire deep dive, how your creditworthiness is actually assessed.
Yes. The directive lays down strict new rules here. Under the European texts, specifically Article 18 and Recital 55, any creditworthiness assessment must be based on information that is relevant, complete, and accurate.
Which sounds pretty standard, but then there's an absolute prohibition that really caught my eye. The law explicitly states data from social networks must not be used for credit assessments.
Correct. No matter how useful an algorithm might find your social media habits, your check-ins, or, your online friend network to determine your reliability.
The bank is legally forbidden from using that data to decide if you get the loan.
Exactly. And it goes even further than that. The rules state that if automated processing like an algorithm contributes to the decision to deny or approve you, the consumer preserves the right to a human review.
So here's where it gets really interesting. If I'm applying for a €50 buy now, pay later loan at checkout, and an algorithm rejects me in 2 seconds, how does a bank realistically provide human review for a digital microtransaction without bringing e-commerce to a grinding halt?
It's a great question. If we connect this to the bigger picture, you can see the law trying to strike a very delicate balance. On one hand, you have rapid digital innovation.
Right, the economy demands instant checkout.
Exactly. But on the other hand, you have fundamental fairness. The European Union is saying that you cannot surrender your fundamental rights just for the sake of speed.
But logistically, for a software engineer building this app, how do they actually do that?
It creates a massive logistical puzzle. The institution must build a compliant complaints route directly into the digital architecture. If the algorithm says no, the app cannot just give you a dead end.
There has to be a mechanism like a ripcord, essentially, that allows you to challenge that automated decision.
Precisely, and escalate it to a human being. The bank's internal governance framework has to support this. So if you click appeal, your file is routed to a real person.
Who reviews the relevant, accurate financial data, excluding your social media, of course.
Right, and makes a final determination. And they have to prove that the human review is meaningful, not just a rubber stamp of the algorithm's output.
That is mind-blowing. The sheer operational cost of staffing human reviewers for potential appeals on microtransactions must be keeping banking executives awake at night.
Oh, without a doubt. They can't just rely on the black box algorithm anymore. They have to staff the safety net.
And document exactly how that human intervention mechanism works before the product ever goes live.
Yeah.
Okay, let's ground this geographically. We've talked about the sweeping European rules, But all of our source material specifically anchors this implementation in Luxembourg.
Yes.
Why does this tiny country's execution of the law matter so much to the broader European landscape?
Well, Luxembourg holds a very specific strategic position. It is a major financial hub. Many of the banking platforms headquartered or operating there don't just serve local residents.
Right, they serve cross-border clients all over the continent.
Exactly. They host multilingual digital journeys. So when an e-commerce platform processes a payment for a customer in Germany using a financial service based in Luxembourg, the national transposition of this EU law into Luxembourg domestic code must be absolutely flawless.
Because if the Luxembourg rules don't perfectly map onto the European directive, the whole cross-border e-commerce machine breaks down.
Precisely. And that brings us to the countdown. The timeline here is non-negotiable. The European deadline for member states to transpose these rules into their national laws is November 20, 2025.
Right, but that's just the date the laws have to be written on the books. The actual operational date, the day the old rules vanish and these new measures fully apply to the market, is exactly a year later, November 20, 2026.
Yes. And from that point on, regulators aren't just going to walk away. The directive mandates official evaluations every 4 years, starting in 2029, to ensure the rules are actually working.
And currently, we are tracking Luxembourg Bill 8708, which is the local vehicle for this massive change, right?
Correct. It's sitting in committee right now, gathering opinions from local consumer rights groups like the Union Luxembourgeoise des Consommateurs and the Chambre des Salariés.
And reading through the bill, one detail that really stood out as a headache for app developers is this specific mandated warning text.
Oh, the warning string, yes.
Yeah, it's not enough to just say, be careful. The Luxembourg bill proposes a very precise legal string of text. Attention, emprunter de l'argent coûte de l'argent, which translates to caution, borrowing money costs money.
It's very specific.
So if you're an app designer in London or Berlin building a checkout flow for a Luxembourg-based bank, you have to ensure that exact phrase is hard-coded into your digital screens at precisely the right moment in the customer journey.
And you must ensure it displays correctly across multiple devices in multiple languages without disrupting the transaction, all while perfectly satisfying the compliance officer's audit trail.
So what does this all mean for the professionals actually working in the financial sector right now? If you're looking at this timeline, what is the ultimate priority?
This raises an important question regarding readiness. The market focus right now is purely on execution. There is no crystal ball needed to guess what the regulators want.
The dates are fixed. The structural pillars are set.
Exactly. The absolute priority for any institution is mapping their product perimeter immediately. They cannot wait until late 2026 to figure out which of their apps or services qualify as credit under the new €1 threshold.
Because they have to retroactively apply these rules, right? It's not just about the new products they launch in 2027.
Right. The old rules are repealed in November 2026, but institutions have to comb through their massive portfolios of existing open-end credit agreements and bring them into compliance.
Wow. It is a monumental sequencing task.
It really is a permanent upgrade to their entire governance framework.
Okay, we've covered a huge amount of ground today. Let's recap the core takeaways for you. The Consumer Credit Directive 2 is a massive operational shift hitting the European market with a hard operational deadline of November 2026.
And the scope of what is considered credit has radically expanded. It now captures almost everything from a single euro upward,
explicitly pulling buy now, pay later products into the regulatory net.
Furthermore, when banks assess your ability to pay, they are strictly forbidden from looking at your social media data.
And if an algorithm makes a credit decision about you, the digital platform must provide a clear pathway for a human to review it.
And finally, to pull all of this off without facing massive fines, banks are being forced to build defensible launch packages.
Those bulletproof audit trails that connect their marketing, their algorithms, and their customer complaints routes into one unified legal story.
It is a fascinating evolution of the law catching up to consumer technology.
Yeah, absolutely. So the practical application for you. The next time you are shopping online, maybe looking at a new jacket, and you see that little prompt offering to let you split the payment, pause for a second.
Just think about it.
Yeah. Recognize the immense invisible legal machinery and human review safeguards that are actively operating behind that single click. You aren't just clicking a button, you are engaging a continent-wide web of consumer protection laws.
It definitely changes how you view a simple checkout screen.
It really does. And I want to leave you with a final thought-provoking idea to mull over. We talked about how this directive explicitly bans the use of social network data for credit assessments to protect your privacy today.
Right, acknowledging that what you post online shouldn't dictate your financial reality.
Exactly. But as our digital footprints grow, our lives are producing endless streams of alternative data. Think about your smartwatch tracking your health, or your phone tracking your daily location. If regulators had to ban social media data today, what other seemingly harmless digital breadcrumbs might they have to explicitly ban from our financial lives tomorrow?
A very compelling question to consider as digital ecosystems become even more interconnected.
Definitely something to keep an eye on. Thank you for joining us for this deep dive. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Deep Dive.